All is good in the hood. What's happening? What's new? Anything strange or dangerous your end?
It's always dangerous, mate. You know that.
Yeah.
And definitely strange from time to time. That's for sure as well. So every day's a school day, isn't it?
Indeed.
Yeah. How are you? You had a good week?
Yeah, just lockdown hasn't really affected me because I spend literally all day every day in my office, and I never left the house even before lockdown. So yeah, house arrest is fine for me.
It's a funny thing, isn't it? It's like the volume of work that we get through, I don't know if you found this, seems to have gone up exponentially. Just because you're kind of anchored to your desk, really. So I kind of look at the end of the day and think, God, pile through so much stuff. But I don't know. I don't know what it's going to be like when we actually finally have the permission of our government to be free people again. How that's going to look and feel. That's going to be an interesting experience. But whether we'll sink back to long leisurely lunches with lots of wine, I'm not really sure, Siam. So we'll have to wait and see, won't we?
Maybe every now and then, but I'm never doing like a coffee meeting again. Because like a quick coffee meeting, like even if it's half an hour, really it's like an hour or hour and a half out of your day to drive there, park up, coffee, and then drive home and all that sort of stuff. So
yeah.
Zoom is just way better.
I think coffee and Zoom is a new thing.
Yeah.
So definitely do that.
I like the digital wine evenings we have. Tonight at 10 o'clock, we're in a group of hedge fund guys, and it's a digital whiskey night, which is
nice.
We've got people from all over the place: Vail, Colorado, San Fran, New York, and some little dude from Scotland.
I think it depends, Dan, which whiskey. That's probably the key question, really.
Yes, absolutely. Well, it'll be Glenlivet 12 for me this evening. And
Glenlivet, okay. Yeah. I think my favourite is Dalwhinnie. I'll go with a Dalwhinnie.
Yeah.
I got
my
one for you
favourite's
guys.
More, actually.
Well, Andy goes.
What's your favourite tipple then, Andy?
Well, being in Spain, I didn't realise till we came out to Spain that they have an 8-year-old malt. Because by the time I get to the end of the night, I look at the top shelf, and they've got some great stuff like, well, you can argue whether it's great stuff, but they've got some black label and what I'd call UK malts, and they charge you €1 a shot. But they've got this Spanish whiskey that was called DYC. And the one night I said, Carlo, I'll have a DYC. He said, no, Andy, in Spanish it is dick. I said, Carlo, let me explain in English what dick is. So now he looks at me at the end of the night and he goes, Andy, would you like a large dick with me? That would be very nice, because it's quite nice malt.
Friendly bunch over there, eh?
Dan, now I understand why you spend so much time in Spain when you're allowed.
Oh, that's below the belt, guy.
Oh, sorry, mate. Sorry. Shall we get on with the room? That's kind of it's a good intro. So good to see you, Phil, as well. Sorry, I missed you off our list earlier on today. Not intentional, I promise. So
no, it's all right. You've seen Sleeping Beauty, haven't you? You know what happens when you don't invite the people that you should invite.
Oh, absolutely, mate. I get it. I understand. Morning, Gavin. Good to see you, mate. You've missed all the fun and games talking about malt whiskies and dick.
Oh, really? Okay, I have missed a fascinating conversation. Yeah, morning, everyone.
You have indeed, yeah. So good to see you again. So I just thought, for the benefit of our audience, we've got some regulars, which is lovely to see everybody, but also for some of the newcomers. So welcome everybody to the room. Just to explain a couple of kind of simple rules, the way that we run it. It's very much a live Q&A. There's no particular agenda. There's no particular set process that we go through. We encourage people just to literally raise their hands, and we'll invite you kind of in the best order that we can onto the platform and ask the question, really. And then the panel, these amazing guys that we've got huge amounts of experience of business, acquisitions, selling companies across the board, really. So it's fun because it's interactive and it's live, and anyone's got a question, we'll tackle it as we go along. But put your hands up. If you're new to the room, then connect with the panel. All of us have got some kind of connection, whether it's on Instagram or something else, and do connect with us, because we do genuinely like to help people as best we can, really. So there's no other agenda other than that. The other thing I was going to kick off with today, it's not something we've actually got onto in previous rooms, and I thought might be a useful start point before we get into questions. Alex has come up, so I'll come to you in a minute, Alex, but I just thought it'd be useful just to talk about the cash flow that you can get from acquiring a business, which is not something we've actually got onto as a topic previously. But I'm sure for many people, it's one of the key reasons why they might want to consider buying companies. And certainly when I was re-entering, setting up the room, I was thinking about the components that we put in the headline, and logically about sort of how you grow your wealth. But it's not just about shareholder value and the exit, it's also about cash flow. Buying companies should generally generate cash for you. So I thought it might be a useful topic just for us to kick around, chaps, before going back to the audience. And certainly myself, Phil, Siam, Dan, and we've all got experience of this to some extent. I know Gavin's working on this as well. So Dan, any thoughts from you on the benefits of buying companies and the cash flow that you can generate, at least in the short term, that I think is a worthwhile topic? Would you agree?
Oh, absolutely. For me, cash flow is the foundation of everything. Capital events are fantastic. They come now and again, but if you're not basing your strategy on cash flow day one, then you're really putting your deal at more risk and yourself personally at more potential liability. So we always, whenever we go after anything, it's got to be, number one, is the cash flow day one? Number two, how safe is that cash flow? How guaranteed is it? What length of tenure do you think that's going to last? How can we boost the cash flow? And then, okay, if the cash flow element's fine, how do we then add value? Because the one thing that kind of separates men from assets is over leverage. And there's somebody who was speaking to in the club yesterday, and this is quite an interesting example. Have I got a minute or something to tell you, or do you want me to tell you later?
Yeah, go for it.
No, yeah, it's a real interesting case study, because this chap is a club member. He bought a company. Now he's one of your mentees as well, guys. So great. And I see business buying and commercial property as two sides of the same coin. When you understand both elements, you can really make great gains. Now, so what does that mean? Well, what it means in a real life example is this chap bought a business, $1.5 million, plating business. You probably know it, guy. Doing quite well, been around since 1945. And this chap asked me, how can we relocate the business, and then if we can relocate the business, what can we do with the property? So we kind of had a live deal clinic session on Wednesday, and we came up with 3 game plans for the property. They were all about the 1.5, 1.6 million profit, which means as soon as he relocates the business, he's got the whole thing for free, and he's got 3 avenues to go down that. So for me, cash flow is great, but zero leverage with that cash flow is even better.
Even better,
absolutely. Another one yesterday was a chap who's buying a block of flats, which is not a business, but it's going to be turned into a business of an apart hotel, service accommodation, and that one's very much a business buying strategy, despite it being property, and it's getting incorporated into a company. Then the owner puts in the 25%, but he gets paid in shares for it. Yeah. Now, as soon as it goes into service accommodation, it's a commercial asset, and you can claim cap allowances on a commercial asset, which are kind of tax breaks, big tax breaks in commercial. Now, as soon as he does that, he basically negates any corporation tax for the next kind of 4 or 5 years, which means he can use the excess in the cash flow in the company to buy back the shares from the vendor without him paying any money. So effectively, the cash flow or excess from the defensive capital allowances, and what does it all mean? HMRC are basically paying for the shares back for them while he enjoys the cash flow in the business.
That sounds terrible, that Dan.
Yeah, it was a thing of beauty, and Wesley's deal, who you know well, is also a thing of beauty, and it was such a simple 2-part strategy. Alex was there on the live deal clinic call, and it's a way to buy businesses with the underlying commercial property, really benefit from cash flow day one, while we then work out the asset for better use to get down to debt zero.
It's interesting because traditionally, certainly from my perspective, quite a few other buyers of companies that I've worked with, occasionally, not often, but occasionally, you'll find the target company owns the property that it operates from, for argument's sake, and that sits on the balance sheet. But curiously, from a funding perspective, it's not particularly popular with funders. They don't really like the property component, and I think that's because there's often a distinction between funders that are interested in commercial property and funders that are interested in trading entities. So often it's a case of saying to the vendor, look, we'll hive off the property, you keep it, stick it in your pension or whatever, and we'll concentrate on the trading entity. But what's interesting now is the things that you've talked about in terms of the massive transfer of assets that's now going to happen over the next few years is creating the kind of opportunities that you've just described, that when I started buying companies, sort of 10 years ago, just wasn't a feature on the landscape really. So I think, it seems to have changed. Would you agree?
Yes, but it's really based on a foundational understanding of what you can do with the commercial and the business side of it. Because usually either some people's on the commercial side and they're just interested in the property, some people's on the business buying side, oh my god, there's a property in it, nightmare. Where I always look, if there's a property in it, fantastic, we've got a double opportunity here. And why is that? It's because of this fundamental fact that usually, like, take that example, business has been around since 1945. They've owned the property for years. The value of the property's gone up, yes, but the alternative use of that property is worth significantly more, actually double, a little bit more than double more, as something else than it is just now, which means the business can't afford to be in it.
Yeah.
So real estate business, alternative use, for the property.
It's that return on asset, isn't it? That's the critical factor that you're looking at there.
Yeah, and one of the strategies is super simple, and he's on a mission to try and make that happen just now. We're gonna help him. The other one is still a great strategy. It just takes a little bit longer, to be honest.
Yes.
So, but it's all back to the question. It's all on foundations of cash flow. Cash is, seemingly cash is king. But I know a lot of people sitting on cash, and over the last year it's eroded because they didn't have one thing: cash flow. And cash flow is the ultimate in sustainability, getting you through any kind of Murphy's Law event. And Murphy will always come.
Murphy definitely does come. He's been coming for the last 12 months. He keeps knocking on the door, this Murphy.
And when Murphy knocks, you should open the door and say, Murphy, welcome in. Come on in, brother. Yeah. Because whenever there's a challenge, there's a seed of an incredible opportunity within that challenge. Welcome him in, put a bacon roll in for him, and sit down together and just brainstorm what you can, really bring out of this kind of Murphy shitstorm.
Absolutely. Siam, I'm sure you've got some great examples of stuff that you've done that's generated unexpected and additional cash flow, which has been quite welcome from deals that you've done. Would that be something that I'd be right on that you could share with the room?
Yeah, I think I think we all probably have good M&A stories with where we've had nice cash flow. But I think a worthwhile comment is the other side of the coin, where one of the biggest lessons I've had in M&A personally is that being a sandbag is the most it just sucks completely. And what I mean by being a sandbag is where you end up buying a chunk of a business where you're an investor, but you have minimal rights. They don't want to exit the business, and there's no divvies. And then all of a sudden, you've basically bought a whole chunk of this company, and with none of the perks, but all of the hassle and the downside. And I think I was just casting my mind back to all of the disaster acquisitions I've done. And I think and I was just thinking,
they shouldn't be glossed over. Absolutely, they should not be glossed over.
Yeah,
there's a lot of fluff out there in the market at the moment from various organisations, shall we say, saying it's all wonderful and dandy, and just life isn't like that. And I'm sure people listening to this realise that underneath the fluff there is some tough stuff that can happen, really. And part of the thinking behind this room is to share that openly and honestly with people, so that it's not fluffy. It's great, but it's not fluffy.
Yeah, I think so. I think there are 6 businesses where I've invested in or bought into, where even to this day, right now, I'm a sandbag. So some of them I own, nice big chunks. But what's happened is that, I guess with those 6, I bought them when they were a bit small, if that makes sense. So they were making profits to begin with, but for all sorts of reasons, there wasn't enough cash flow to pay out a divvy. All the cash has been, trying to keep the business running. Because one of the things I like to do is keep a nice cash buffer in the business. So cash, like Dan is correct, cash flow is everything. And the businesses I've been in where they've basically spent or dished out a divvy of every spare penny, it leaves the business in a bit of a precarious position, because when a downturn happens or you have a month of bad sales, guess what? You're short of cash, and then all of a sudden you're into borrowing.
When Murphy knocks on the door.
Yeah, exactly. He sort of lives in my spare room over here. But and so one of the things I put in the shareholders agreement when I jump into a business is that at minimum you need at least a 3-month runway. So whatever the OPEX is of the business, we need at least 3 months OPEX sat in a bank account. Ideally more, but then once we've got past that 3-month buffer, then we start doing divvies. But the problem is, because I'm putting that buffer in, some of the time in the past, I haven't had any divvies for a long, long time, and I'm sat there going, I'm dealing with all the hassle of the business, or some of the hassle, and I'm not getting any of the perks. So this is why personally, my criteria is I only buy businesses that have been running for at least 3 years worth of accounts, so they must have been running for at least 4.5 years, 30% net margin minimum, 300 grand net profit minimum, management team in place and scalable online. But it's that 300k net which is my sort of minimum level now, because I know that when I do get in a business doing that amount of profit, there will definitely be divvies.
I always had a maxim in our modelling when we were buying companies of having, ideally, as you say, a minimum of 3 months, sometimes 6 months working capital. And for me, working capital was effectively what I call the burn rate. So the overheads of the business. If people have to turn up, put the lights on, answer the phones, there's a cost to that business. And if no sales came in, no revenue, what would that be? So that was my sort of basic maxim, what I call the burn rate. And people used to look at me and say, well, that seems like quite a long time. So, well, what's the worst case scenario? No cash comes in for a period of time while you fix that problem. And people used to laugh at me, and then COVID came along. So the very thing that I talked about that some people said, oh, it never happened. Businesses were shut down overnight. It happened to us.
Yeah.
We Michael Gove last year said, oh yeah, construction will carry on. And we were like, yes, brilliant, slam dunk. And the next day, all our clients closed. It was like shit. We went from 500,000 net revenue to nothing overnight. It's just extraordinary.
Yeah.
And the very thing that I'd planned for but never really expected happened. So yeah, Murphy definitely came knocking that day.
It's those things that make us who we are, isn't it, guys?
Yes.
Guy.
Yeah.
Thank you very much for inviting me to speak. Really appreciate that, and I think I'm becoming a bit of a regular here on your show. Where actually I wanted you to become a regular on my show in my business.
No, that's fine.
I'm loving this. I'm absolutely loving this. And I had a bit of a left field question for the group, if I may.
Yep. Yeah, sure.
An opportunity has presented itself for us to buy a surveying business, and they're doing property valuations for banks from all over the world in London. And so on the face of it, it's quite a good opportunity. And we're actually buying this business without using any of our own cash, which I know many people on this forum are very passionate about.
Yep.
And then we spoke to the lawyer and asked them how much it's going to cost. And then we spoke to the accountant and asked them how much it's going to cost for due diligence. And even with our connections, our very, very strong connections, because we feed these people and we give them work all the time, because we run an M&A business and we do corporate acquisitions, etc., etc. It's still a heavy bill. Mm-hmm. And so what are you guys doing with no money down deals that are becoming very, very costly when you start costing in the price of the transaction?
Can I deal with that as a lawyer?
Go for it, Phil. Yeah, absolutely.
I think first thing is you budget for it right from the start. So there are certain costs you're going to incur. Legals is always one of them. So you need to have it in the budget. In terms of what you should pay for it, there's two competing forces here, Ran. One is if you pay too little, you won't get decent lawyers or service. But on the other hand, some lawyers just frankly charge too much. So for example, there's a transaction I'm working on right now where I'm using good lawyers, specialists in this field, and my legal bill will be under £10,000. The seller, whose side is going to be doing less work than mine, was quoted £30,000, which is just ridiculous. But I've got good lawyers, but I've also got lawyers who appreciate that this is a small, simple, straightforward transaction, and they quoted accordingly. And the other factor that's at play, I suspect, is that my lawyers are in the north. The seller's lawyers were in the south. So one thing you could do on a practical level is engage with lawyers who are not in London, because it doesn't really matter where they are. And there are some very, very good corporate lawyers in the regions. So you could do that straight away. But
it is a big change, Phil. That it was a time when I started where transactions had to complete. Everybody was in the same office, all that kind of stuff, and the legal profession, thankfully, has joined the rest of us, and that stuff can be done digitally. So that does make a big difference. And Phil's right, Ran. You could and should think about finding regional lawyers who are perfectly competent, professional, good at what they do, but will charge a fraction of the London people.
Sure, thank you. I really appreciate that, and as you will appreciate, being in this industry for a very long time, we are connected all over the country. The main issue that we have with that is the other lawyers are always, the seller's lawyers are always opting into the position where the business doesn't cost you anything, so there's going to be no warranties. Well, the business doesn't cost you anything, so there's going to be no this, no that, and we want a part of the exit if you exit, etc., etc., etc. And they keep going. But actually, these transactions are not free. Even when they are vendor finance, they are not free.
No. Well, two points on that. That unless it's a distress purchase, where you're buying an asset, a business that you know is in distress, i.e., facing liquidation or administration or something of that nature, an insolvency event, then that doesn't justify no warranties, in my opinion. Warranties are there to protect you and to some extent to protect the seller. If they're open and honest in their dealings, then why wouldn't they sign warranties? So for me, I think that's really key. But to go back to the other point of your question, we try very hard to make sure that all the fees are contingent on success. So the fees should be paid at completion, and they should be paid out of the deal. In other words, the target acquisition. So if you can look at the numbers in those terms, you should find the deal will pay those fees for you, Ran. That would be my approach to deal with that particular issue, and 100% contingent, because that focuses everybody's minds on getting the deal over the line.
Yeah, very good, very interesting. Thank you very much for that insight, and I'm loving the discussions. Loving the discussions on this group.
Good. So let's come to Alex, because you popped up with a question. What's your question, Alex?
Good morning, gents. Thank you very much for sharing some great insight already. And probably you've partly answered my question. But when buying a business, I appreciate there's a lot of softer things to concentrate and look at. But in the end of the day, you do also need to drill down into the financials and the accounts. Mm-hmm. When you get the management accounts, and I know Siam mentioned we want to look for the last 3 years. Yeah. When we're going through them, do you have kind of set requirements? What are you looking for when you're going through there to ensure, that business is healthy? Because I appreciate sometimes the accounts don't always tell the picture. Yeah. So I just want to know what you guys look at.
I'm happy to answer that, but there may be, I don't want to hog the panel, so I don't know if Gavin, if you got any thoughts on that, Gavin? Because obviously you've got a lot of experience of looking at businesses and a sort of a banking background as well. So anything you want to come in on that?
Yeah, I think actually in early stage of my career was with KPMG, so Chartered Accountant qualification, and I look for trends. I look for trends in the data. So are you seeing an upward trend in terms of profitability, in terms of sales? What you're seeing around the assets on the balance sheet? For example, I was appraising a business earlier on this week, and it's amazing how much you could deduce by looking at the age of the directors, changing on Company's House. The asset value would drop significantly, and I predicted it was parents had handed over the business to their children, brother and sister team now running the business, and as part of that exit, they tied off the properties of the business into pensions. And I was able to work all that out by just looking at changes, the assets, changes in the cash flow and profitability, and then also, Company's House registration details of directors and when they resigned, etc. So then when you go into a conversation, you've got a picture or a hypothesis in your mind about what could be going on in the business and where the opportunities might be. So, looking for trends, looking for different expense lines when there's a detailed, not always the case, but the detailed P&L in play where you can get access to that evidence, or looking to how liquid the business is and, are they technically insolvent or have they got a strong asset base from which you can raise funding off.
That's a great bit of insight there. Andy, anything that you would add into that? In your years of business coaching, you must have looked at God knows how many sets of accounts along the way.
Well, not as much as some of you guys, I don't think. And I've been fixated on LinkedIn for the last bunch of years. I think, you guys have sort of covered it, really. There was an interesting point earlier. You know me, I'm sort of more about I was going to say the people side. Lawyers are an interesting breed, as we all are. And I can say that because my brother is the commercial property lawyer for the Travis Perkins Group at board level. And he and I are very different. I think I'm just a big believer there's no rules, is there, with negotiation? And also I want to get to the decision maker. I do struggle, and I understand why accountants and lawyers are acting on the behalf of their clients, but they're often coming at it from a different level of experience than maybe the vendor, and certainly you guys as the buyer. So it is about negotiating with them. And I guess a bit like getting to the vendor. I don't want to get to an agent, I want to get to the vendor and create rapport and deal directly with them in the same way. I don't really want to talk through lawyers unless really necessary.
No, I agree. To answer your question, Alex, directly in terms of what do I look at on the accounts, I look at two things really. Like Gavin, I very much do a trending exercise. So we have a simple spreadsheet that extracts ideally the last 5 years accounts, which is obviously historic, so it's not about the future, but the history is an indication of what the future might look like. So we will just simply focus on three components: so the sales, the gross profit, and EBITDA, and sometimes post-tax profit. The reason why we do that, first of all, are the sales going up? Are they leveling, or are they going down? Because that's a key performance indicator. What's the health of the business in terms of revenue? Gross profit's really important. You may know this when you look at numbers, but it's amazing. A lot of owner-managed businesses are often quite shy about raising their prices, but the impact of a 2, 3, 4% rise in price, which obviously is on gross profit, can have a really dramatic effect on the cash at bank if all of the things stay equal. So if your overhead structure remains the same, your cost of sales remains the same, by tweaking your prices, and often 1, 2, 3% customers won't really notice, can genuinely drive a significant amount of extra cash into the bank. So that's one of the key components that we look at, and we ask that question: when did you last raise your prices? And then obviously the component of pre-tax and post-tax profit is critical, because in the funding community they tend to look at EBITDA, earnings before interest, tax, depreciation and amortization. But in our world, we're looking at what cash have we got to play with, which is post-tax, because corporation tax is an overhead to the business regardless who owns it. So you have that kind of dance around the handbags of EBITDA and net profit. And those are the things that we look at in terms of the P&L. But the balance sheet is often overlooked. And when I was first in business, I never looked at my balance sheet. I only ever looked at my profit and loss because I was only interested really in A, what I earned, and B, what was my tax bill. But the balance sheet is the bit that I always overlooked in the early days, but it's where the shareholder fund sits, where the intrinsic value of the business sits. And if you start to understand the balance sheet, a lot of what's actually happening in the business is like a story that you read from the balance sheet. So the movement in shareholder funds, how much are the shareholder funds gaining each year collectively, also often tells you how much dividend the owners might be taking, and often dividends are not declared in a set of accounts. So you can work out what the dividend might be, and there's a hidden cost there. So often you'll see business owners will only draw £12,000 salary each, but obviously that's completely unrealistic. If you were employing somebody to run the business, you've got to pay a market salary. So there's some adjustment work needed around a P&L, and therefore the true profit. How much is their dividend? Their dividend is often an expectation of what they think the business will be worth. So if you think about it logically, someone that's been pulling out, say, 150 grand a year, and you put an offer on the table for a payment on the day plus deferred consideration, the very simple equation they're going to do in their head is, well, this business has been paying me 150 grand a year. If I just keep it, how much am I going to continue to take out of the business for the next 2 or 3 years? And basically, if your offer doesn't beat what they've been taking, chances are they'll just keep it, as daft as that might be, unless they're ill. So you can glean a lot from the accounts to get your head into the scenario that is what the owner will be thinking about, just as much as you're thinking about as a potential buyer. Does that make sense?
Yeah, that was some gold nuggets there. So, the next thing to look at, just quickly, is linking back to the start of this conversation, is cash flow. And one of my first questions is, have you got a cash flow forecast, and can I see it? And I don't know about your guys' experience, but in my experience, many businesses actually do not have a cash flow forecast, and they manage. And so I found that actually by generating one with them, you can see opportunities to extend your credit from suppliers, manage your payments to customers, change your cash flow cycle from being negative to positive by either part payments up front or complete payments up front, putting people on subscriptions, and the list goes on. There's a lot you can do with cash flow that in its own right not only generates that cash coming in, but also can actually generate that extra gross profit as well, particularly if you put people onto recurring subscription type payments.
Oh, Gavin, you just opened a whole can of worms. I love that comment about asking the owner for a cash flow forecast. My God, if I had £1 for every time they look at me blankly and go, well, I've got half a million in the bank, what do I need that for? Honestly,
exactly. I've had the same conversation so many times.
And also £1 for every...
And so many of these business owners just run their business by how much they've got in the bank. It's just extraordinary, really. Go on, Siam.
Yeah. I was also going to say, if I had £1 for every cash flow forecast that has never come to fruition, I'd be rich as well. Honestly, I've never seen a cash flow forecast actually...
Whoever produced the forecast that didn't look good, hey?
Yeah, hallelujah to that. If I had 100 quid for everyone, we might not be here today.
Also, Alex...
Yeah, absolutely. But here's the thing. So we try now really hard to engage in that conversation with vendors early on to go, well, you must have some kind of budget. You must have a forecast. What do you think you're going to do for the next 12 months, 18 months, 24 months, And even then, they kind of look at you blankly. Well, we'll do this. They go, great, well, that's the start point. Come on, give me what you think you do. Forget that you're going to sell a business. You don't sell a business, you keep it. What are your expectations? And actually, if you just have that really honest and open conversation with the vendor, you start to get some real gold out of them that will help you massively in starting to structure how that deal might look. But having that open and honest conversation, because you'll never get it from a broker. They're just utterly clueless. With the odd exception, there's a few small brokers who are really good people. But the vast majority, certainly the big kind of what I would call retail brokers, totally and utterly clueless. So you've got to engage with the vendor around that topic for sure.
Sure, and then Guy, what do you do? What do you do with the over-optimistic vendors? Who tells you, I've only done 500,000 turnover this year, but I've spoken to this Siam person on Clubhouse, and he told me it's going to help me make 10 million my projections is 10 million, and now I want 50 million for my business.
Mm-hmm.
I think time is a great leveler, Run. Time is the ultimate, knocking down of those false assumptions, just like legs under a table. It takes multiple people to knock the door, kick the tires, and then, expectations, change. And that's just a factor.
A good line to take with people like that, Ram, is that's fantastic. I really hope you get your £10 million, but if by any chance you don't, I'm still here, so come back and talk to me.
Give me a call.
The best deals always happen 18 months later for me. So you just gotta pop in your calendar to touch base every 3 months, just to send a text.
This is a true story, Ran. I had a meeting with a guy like that, and I can't remember why now, but for some reason I had a drawing pin in my bag, and I sat there and had a flash of inspiration, and I was smiling, and we were kind of laughing about it because he knew he was being a bit ridiculous, and I knew he was totally being ridiculous. And I reached into my bag to kind of put my stuff away, and I saw it, and I went, "Look, I tell you what, let me give you this." And I passed him the drawing pin. I said, "When you've burst your bubble, give me a shout." And he burst out laughing, and we parted on good terms. I never heard from him again. I know he didn't sell the company, but I did give him a pin to burst his bubble.
That's a great story. I love that. Absolutely love that. Another thing I would look at, if you're looking to try and buy the business, and you got to assess it straight away, is look at the cash in the company, the loans, the directors' loans, and debtors and creditors, because those 5 elements can be a massive component of funding anything. Yeah. And then I would also look at the adjusted EBITDA. What is that? Well, like Guy said, he might be on 12,500 dividends, £2,000 of 12,500 personal allowance, £2,000 of dividends, and £1,000 a year maximum interest you can have on your loans without paying tax. And he might be doing that. So what's the cost of employing someone else? Number 2, maybe he's got a ton of personal overheads in there that perhaps may not be in there going forward. So if it's a savvy, knowledgeable vendor, he'll have adjusted that EBITDA to rip everything out. You then want to adjust it back to put back in what's supposed to be there. But the key thing is for me is post-tax profit is what you keep. That's fundamental to what you're working on, your debt coverage, if there is any debt coverage.
Net cash.
Absolutely. Net cash, what are you keeping? But you have to adjust that to find out what the true net cash is going forward. And then after that, you've got to think about what's the corporation mitigation strategy going forward, so you can actually accelerate that, before you get in.
Yeah, what Dan's talking about is you got to ask them what their bobs are, and they look at you blankly, and you go, the business owner benefits, your cars, your holidays, your house repairs, what do you put through the business? And I'll say to them, look, seriously, if you're running a business and carrying all the risk and all the pressure of owning an operating company and employing people, if you're not putting at least some kind of bob through your business, then you're nuts. So I don't have a problem with people doing that. I just want them to be open and clear with me, so I'm not finding it later down the road and then it becomes a difficult question. So always early on in the process around that.
And your business owner benefit story. Sorry, guys. My best business owner benefit story recently.
Philip, just before you start that, because I know you're going to drop gold, right? I just so that everybody knows, Philip is about to drop gold. I know he will. So if you want to get that gold, and if you want to get those nuggets that everybody's dropped and about to drop by Philip and about to drop thereafter, if you want to get a transcript of the call, I've got an executive assistant typing up the notes right now. If anybody wants copies of that, we're going to do it going forward as well for all our clubhouses, Guy's clubhouse. All you need to do is poke all the moderators in the face, follow them on here, follow them on Instagram, and let me know you've done that on Instagram, and I will give you a link to the Google Drive for everybody here.
Awesome. What a top man you are, Dan. Thank you very much.
I thought it was going to be a cheeky lead magnet there.
Brilliant.
With an opt-in page.
you got to give some to get some back, Siam. That's the deal.
It's all in the service, Siam. Good at good stuff, you get good stuff back.
That's it. Go on, Phil. What was the goal you were going to drop?
The business owner benefit. So I was having exactly the conversation you described with the owners of a smallish consulting business, and I asked the wife who owns half the business, is there anything else that you put through the business that relates to you and not the business? And there's a pause at the other end, and then she said, there is the racehorse. So
I love it.
Turns out there's 30 odd £30,000 a year in stable fees.
And what was it put through the P&L as? I would love to see the nominal code on it.
It all goes under miscellaneous or other expenses.
Salary.
Exceptional items.
It just goes to show that's actually the second racehorse I've come across. There was another business I looked at where the guy did exactly the same thing. The entire cost of his racehorse, stables, jockey, everything was put through his recruitment business.
I've come across 2 of those in my time as well. So, funnily enough, it was a business based in Newmarket as well, of all places, but the home of racehorsing. But I have come across that before.
Yeah, so Guy, could you tell a story? I remember being on the phone to you at some point, and you said to me something incredible. Dan, I'm going to have to go because I'm away to buy a helicopter company. And I thought, okay, I don't mind getting dropped for that. Please share the story. What a wonderful story.
Yeah, unfortunately it didn't happen, but I'm going to invite my partner, long-time friend Terry, onto the stage because it was actually Terry. Terry has been getting his helicopter pilot's license. I know he's lurking here somewhere, so I think good job, Terry. You come and joined us on the panel. So I'm going to let you lead on this one because it sort of came through you, I think, really originally, and it was a nearly done deal, wasn't it?
Yeah, it was nearly. Can you hear me, guys? I don't know if you can hear me. It's my first time on.
Hey, buddy.
Speaker.
Yeah, no, we got you.
And I still promise you that flight, Sam. If we finally get there out of lockdown. Yeah, it actually came from. For everybody listening here, it came from something similar to this, where guys on a podcast, and the lead came through, and we were very close to doing the deal, and I know Guy was in the meeting that morning, and it's again. Just a wonderful example of what's been created here. It's my first time on here, and I listen to it every week, and it's just a marvellous platform, listening to everybody and learning from everybody. But the helicopter company is just one of them things that, as you're growing up, you think to yourself, I always wanted to do that, and being involved in acquiring businesses has helped me to do that. So, but it was a great one, and we were very close, Guy, weren't we? But it just didn't come off. It just didn't come off.
It was an interesting case study because why it didn't happen was to do with the kind of the deal structure and the company structure. So these guys had bought a piece of land. They lived on the piece of land. They built a helicopter facility, both commercial and pleasure. But the problem was that we said, well, look, the only intrinsic value, the helicopter company itself didn't really make any money as a trading entity. But it owned some helicopters and had, apparently a very strong balance sheet. But when you looked at the underlying trading performance of the company, it was pretty rubbish. So it's always going to be a problem. So we said, well, look, a bit like this you would have loved this one, Dan, because it's like, well, okay, how do we separate out the asset which is worth something, the physical buildings, the heliport, the property, and do something with those, split those out, make those cash worthy, as it were, and then we can deal with the trading entity and support the trading entity with a new structure. And we put all of that to them, and they just said, no, we're just going to carry on. And it's really sad because they're, I don't know, in their 60s, I think, Terry, and you go, what's your exit strategy? How are you going to get out of that? It's just
Guy, we should really look at that 100%, and whatever value you think it's worth. I'll take half of the upside that I bring to the table.
You're on.
On that day that you told me that, I just always seen you as a guy, my friend, my buddy. From that day on, I seen you as 007. It was awesome. What a line you dropped on me.
I used to own.
I don't think 007's ever had ginger hair. That's the only trouble. Otherwise, I'd be there.
I used to own a helicopter company, and the thing with aviation businesses is that you must absolutely stay away from B2C aviation businesses, and you need B2B. So it's as in business to so companies that teach like PPL training and stuff like that. It's one of the toughest businesses out there, and you have an incredible churn rate with students, as in people starting out their pilot's license and then quitting. So if you do get into aviation, it absolutely needs to be B2B. And that's where the chunky contracts come in. So.
Yeah, no, I'd agree, Siam, absolutely, and that's what we saw when we looked at the business, really. So, as much as we wanted to help them, but actually, Dan, I think that's a good shout. I think that's well worth re-examining because they won't have sold it. They won't have gone anywhere with it.
No,
they're just going around in circles, really. So
I'm sure they've eaten through a lot of cash in the last year and a bit. You know.
Oh God, yeah, absolutely. Yeah.
I think, Guy, just add a little bit to that. I think also, if you plan to do something in your life, i.e., learn to fly, I think it's all to do with your acquisition strategy. Why not buy the company first, and then learning to fly is free rather than spending 30, 40 or 50,000 on learning? That's just a point that we thought about in that way, and then we can move it on later on.
And it's a good way to get
put all your assets to fund your lifestyle, for sure.
Yeah, I love that. Moving costs post-tax to pre-tax. Love it.
Yeah.
Sam, are you going to say something?
Yeah, so going back to, I think Alex's question earlier, because when he was mentioning about the management accounts. So, personally, as you probably gathered by now, I have a somewhat jaded view on lots of different things at the moment, especially in M&A, and so I do not trust management accounts with a barge pole. I do not trust P&L, simply because of the fact that I've met and worked with enough accountants that you can make an absolute horrible business look pretty when you put when you sort of massage the facts. Now, the thing that pierces that veil, that bullshit veil, are bank statements. So I am obsessed with bank statements. So every time I go into a business, I need to see at least the last 6 months worth of bank statements. And then I go through the painstaking process of, I've got this spreadsheet, and I go through every line item in the bank statement. It could be, Tesco shopping, whatever. Okay, it'll go under Tesco shopping, and then you'll have a spreadsheet with literally sometimes up to 1,000 rows of different expenses, and then I have to categorize them all. But then you start to see trends. You start to see, okay, what's this? What's this? What's this? What's this? And there's one business that was supposedly doing about 60 grand a month net profit, and it turned out, God, this was a long time ago. This guy was running a good 40 grand a month of personal outgoings through the business, as in going back to the Bobs. And because when I had my list of questions, what's this, what's this, what's this, it was basically row after row of highlighted yellow rows that I was doing. And I then had to create a whole new Bob expense column, and it was just obscene. And if anyone's stealing cash, playing around with the funds or whatever, you cannot lie in the bank statements unless they give you a photoshopped PDF. But and it takes a long time. But after you do that experiment, it will probably take a whole day or two just to do it. You'll understand that business far better than the business owner does.
Yeah. The other way of doing that, Siam, is just you could do thousands of rows, or you could do real simple basic analysis of a series of columns and just pull across.
Oh yeah, you do that first.
Each of the entries, but you'll still get the same answer, the kind of thing that Gavin was talking about before.
Yeah.
But it's a really valuable exercise. If you're not entirely confident and you think there's an issue, then that's an exercise worth doing.
Yeah.
But going back to Alex's question, you do get a sense from filed accounts, and obviously if they're audited, that's even better. But most small businesses are not audited. But if you get the detailed accounts, you do get a sense of the trending. And in our valuation calculator, we have a weighting component. So we say that anything more than 3 years ago probably can be trusted, in the sense that accounts can be adjusted year to year. And if you see those adjustments, you know there's a problem. But if after 3 years there's no further adjustment, then you can be pretty confident, because ultimately, as you say, Sam, it results in the bank balance in some form or other.
Yeah.
So if you go back 3 years and they've been consistent, then you're in a fairly good place. But do that exercise as you've suggested if you're not sure and you're not confident. The other thing that I do is I look at who their accountants are. So go online, have a little look at who they use as accountants, and you get a sense of, are they using Billy Backstreet, or are they using a firm that have some degree of credibility? Because even though accountants can manipulate the numbers, most accountants are reluctant to do that beyond a certain point.
Yeah.
Because their reputation is on the line as well. So that's a useful sort of quick check. Are they using someone that looks half decent, or are they using Billy Backstreet? And then again, you get a sense of how good those accounts are on which you want to rely.
Yeah, I think Simon, that was a great point. Simon made a great point about the bank statements. So we always get them as well. And what you need to do is get, two things from the bank statements. You need the CSV file, but you also need a PDF to make sure that's confirming the CSV file. Yeah. Because we all remember Barings Bank's faxes coming through.
Yeah.
Request for more money. And you don't want to be, getting tripped up on these kind of things, the basics, because it all starts with bank statements, accounts, and go from there.
Yeah. All the bank statements, by the way, Dan, not just the trading one. Because, again, okay, let's look at all of the bank statements. What do you mean? Oh, yeah, that one. Okay, the slush fund bank statement that sometimes sits there.
Yeah, absolutely.
Yeah, definitely. Alex, did that answer your question?
Yeah, no, that's really good. I think there's a lot of value out of that. Just as a follow-on, if you don't mind, you were talking about things to request, and there's quite a few things that popped out there, but what other things would you be requesting as kind of part of the heads of terms, should we say, with a business purchase? Is there some key items? You mentioned the bank statements as being one. Anything else that's been looked at?
I've actually got a comprehensive due diligence list of things, from everything from lease agreements to insurances, etc. It's a comprehensive spreadsheet. I'm quite happy to ping that across to you. If you just connect with me on Instagram, I'll ping it across to you. So you've got I've got two versions actually, one a bit more in depth than the other. But the point when you pass head to terms and you get into DD, then that list kicks in.
Yeah, we have a DD questionnaire as well, Alex. There's a distinction between pre-heads of terms and post-heads. So there's a deal that me and Phil are working on where we're about to go into the detailed due diligence, and that's going to be done through what's called a data room. It's actually being set up on Teams. So all of the players in the transaction can access the data and see the data as it's developing live time. And that deals, like Gavin said, with sort of contractual matters, the operations of the business, as well as all the finances. I think your question is probably more about how do I assess the company. So for me, the things that we've talked about, but also things like the details of the aged debtors and creditors. Now, sometimes vendors are a bit wary about sharing their aged debtors right in the early stages. So we always say, look, it's fine, you can redact the names of the companies if you want to, although your non-disclosure agreement should cover that in terms of confidentiality anyway. But sometimes people are still nervous. But you want to look at, how old are the debtors? How old are the creditors? Are they managing their cash effectively and efficiently in terms of debtors and creditors? That's a key component as well. So we look at that. You want to look in terms of the debtors of the divisibility of the debtor book. In other words, the greater the spread of customers, the better, because if one customer goes bust, it's not going to affect the rest of the business and all those sorts of things. So some of those underlying factors are really important to ask for quite early on in the process, really. And then the other thing I would look closely at as soon as possible is management team. So organogram, who have you got? Who are they? What do they do? Again, could be names redacted. What skill sets have they got? How old are the management team? Because if you're buying out old owners, but the people below them are just as old as them, then you're going to have to replace them quite soon, potentially. Fred has been there for 60 years. How much longer is he going to last, particularly if his bosses have gone? So some of those components around who you are inheriting is just as important as the numbers, because it's the people that are going to generate the numbers. And if they're not up to scratch or they leave after you buy the business, then you could be in a world of pain. So those are probably the two things I look at the most. Does that help?
Yes, perfect. Much appreciated. Thanks for all of that. And Gavin, I'll link with you. Thanks so much.
Gavin,
thanks, Alex.
One more thing on the aged debtors. I understand what you're saying, Gavin. It's completely understandable. NDA should cover the confidentiality, but sometimes they don't want you to show the aged debtors who they are in case you get in touch with them. But sometimes as part of the funding package, you need to see that, because if you're bringing in any factoring finance or whatever, which is never first, second, or third, fourth, fifth on the table for me, because it's a nightmare for your customers. But if you are, you need full disclosure of who they are, their trading history in terms of their, because what it is, it's like a tenant lease. It's what is the promise of the debtors being repaid now and also in the future, and you usually need transparency on that to provide to a funder to get confirmation of cash flow going forward, kind of thing.
Yeah, you're going to have to know who they are sooner or later. All I meant was that in the initial stages, when you're still getting to know each other, I get it that people can be a bit nervous. But Dan, you're spot on. You're going to have to know who those customers, and you 100% have got to check them out. We use CreditSafe, so we can check the customers of our target company and get a sense of the credit worthiness. And sometimes, we'll even say, do you realise that, your top customer's in trouble? And they look at you like with horror, like, what do you mean? You go, well, look at this CreditSafe report, and changes the perspective of the deal. So something to bear in mind, but you're spot on, Dan. It's really, really important. That's what I mean about what are you stepping into. Are you stepping into something that the vendor is aware of, or are you stepping into something that they're not even aware of, in terms of the risk factors that their current business is facing, really. So these are really, really important things. Dave, you put your hand up ages ago, so I hope you don't mind being patient, but I appreciate you sitting there waiting. So you obviously
No, that's all right. Yeah, cheers, guys. Still here. I just wanted a quick question. I know that a lot of the businesses have got debtor books and everything. I'm looking at B2C businesses, so there's not really any debtor books. As far as forecasting is concerned, are there any tips you guys have on doing cash flow forecasting on a B2C, like a garage service station, things like that? Because they're a bit trickier to kind of get a read on what the next 12 months revenue is going to be.
Very difficult in truth, because you have no contractual basis to rely on. All you can really rely on is historic performance and as open and honest a conversation as you can have with the current owner, really, as well as your knowledge and skill and experience in the sector. Unless you're giving it a go, I wouldn't do it. But if you know your stuff and you know the industry, then you're probably as well placed as the current owner to judge that, really. But I'm not a fan of.
I'd also have a look at what they're doing around their marketing strategies and where's the opportunity to improve on that. What are their other competitors in that geographical area doing? Do you think that actually you could, let's take a garage for example, could you go and look for some fleets and corporate business so you could secure some bigger clients, so it's some bigger chunk of business? So completely concur what Guy said. It's very difficult to project, but what value could you bring to that scenario, to that business?
Yeah, you could. Gavin is spot on. You can't. Your forecasting is really hard, but you can add value by. I can't talk today. Verbally farting all over the place. If you look at Pret a Manger, Pret have just bought out a coffee subscription thing, which is £25 a month, and you can have up to 5 coffees a day every day. And so that is just a part of a play to try and shore up their cash flow and also predict a forecasted cash flow as well. Because when you're looking at like subscription-based businesses or payment plan businesses, forecasting is actually really easy compared to like a garage which doesn't have any sort of recurring revenue and stuff. So if you took a business like a garage with no recurring revenue and added a stream into that, then all of a sudden it gets a little bit easier, but it is tricky. Personally, I just don't play with smaller businesses like that anymore.
Monthly recurring revenue will add value to that business as well, Dave. So if you, I have I'll come to you in a sec, Andy. I've got a Merc, and I pay so much a month for my service plan. So there's a good example of the sort of thing that people are doing now. So I would mention that for sure.
Yeah, cheers, guys.
Yeah. Go on, Andy.
I think I'd reinforce, and rather than dive into sort of micro strategies, I can get excited with this. It depends on your B2C and the size of it, but somebody alluded earlier that most people's marketing is crap in most businesses, and nowadays with social media it's even more crap because people are behind the curve. Most small independent retailers are terrible. So the amount of value you can add with all sorts of strategies is exciting. You get hold of some of the books by Brad Sugars, who founded Action Coach, because that's where he made his money, and he's worth reputedly 100 million, was buying most of his businesses were retail. Because guys, they just alluded to some of the strategies. But if it's a mechanics workshop, how many service stations, workshops write to their bloody clients and say your MOT's coming up? Probably the ability to add sales and revenue, although you asked about predicting, is difficult. The ability to add extra sales and recurring sales and repeat business is likely to be phenomenal, because most retailers are just terrible at it. And that's what I'd be looking at. What can I immediately put into place? So if it's not your forte, you want someone that can help you, just drop in a whole bunch of strategies to increase client spend, client recurring visits, and new clients. It's I think it's easier in retail than it is in a lot of B2B businesses. And funnily, just before this call, I'm sat down here going, I need to set up a new search in LinkedIn to go and connect with people. Who are the easiest people that have got cash to spend with me, and who are the people that I can get the best lead generation results for? Because for B2B on LinkedIn, it's getting more, not necessarily difficult, but things have changed. Whereas retail depends obviously on the business. You know, Pret-a-Manger, they're huge. They've got, I don't know what size business you're buying, but if it's small, privately owned, my first questions would be, how much marketing you got in place, or are you just hoping for people to come through your doors?
Yeah, and we all know the stories, you know, associated with motor dealerships and repair shops and so on. You know, it's not exactly an industry with a sparkling reputation. But I just wanted to add, a good friend of mine and Terry's is actually lurking in the audience, Claire Pinchback. She's amazing and runs Hetty's Tea Rooms in Scotland, and she's very much in the B2C space. So Dave, I'd really encourage you to go and check out Claire in Scotland, Pitlochry, a place called Hetty's Tea Room. When we can all go and travel, everyone should go and have a slice of cake at Hetty's, because she's amazing. But she's done a ton of work in this area, and I would strongly urge you to reach out to Claire Pinchback at Hetty's, because the stuff that she does, will really help you. She's here. Hi, Claire. Welcome to the stage.
Thank you. Can you hear me?
Yeah, I can hear you clear.
Yeah, it was interesting just listening to the conversation just a second ago. One of the things that I think that most business owners miss out, and when you're buying a business, it's one of the things to look for, is the customer journey, because so many opportunities for increase of revenue is missed in the customer journey. From the minute that they interact with your business, whether that's on Facebook, on your website, on your Instagram, wherever, they need to start from the get-go to feel comfortable, to get to know you, to get to know your culture, and all the way through to when you actually shake their hand for the sale at the end. There's so much value can be gleaned from customers that these businesses that you're looking at have maybe interacted with these customers for years, but they're just not getting all of their information, all of their services out in front of the customer, not in a salesy way, but in a customer journey, customer service way. And I think there's so much money left on the tables in businesses that you could. I bet you all, when you walk around and into businesses, you think, oh, they should be doing that, they should be doing this, they should be doing the next thing. But business owners, when they're in their business, essentially don't see these things.
Yeah. That's it. So Dave, connect with Claire. She's a genius and a good friend of mine as well. So, but thanks, Claire.
Cheers, guys. Thank you.
Comment. Yeah. Good to see you, Claire. How are you?
I'm very, very well. Just about to launch a new business. So yeah, very busy, very well, and waiting for the 2 months before Nicola says we can open the doors again.
Oh my God, I know. How good will that be?
That will be very good. I have to say, it's as much as the quietness has been good, I miss customers, I have to say.
Yeah,
so,
absolutely.
Yeah, no,
absolutely.
It's been great. But it's been a good time. I have a 16-year-old who's going through her hires or A-levels, and actually we're never going to get as much time together ever again in our lives as we have at the moment. So it's super precious as well.
That's it. Always look for the upside, for sure.
Absolutely,
so,
absolutely.
Brilliant. Dave, did that answer your question?
Yeah, really helpful. Thanks a lot, guys. Cheers.
You're welcome. Good stuff. AJ, welcome to the panel. How are you?
I'm very well, thanks, Guy. Hope you're all keeping well. Really interesting room again. I've been trying to join on a weekly basis. So I actually put my hand up on the back of the answer to Dave previously. So it was actually a question that I've been thinking about, and the subscription sort of business model is an interesting one, and something that, as you say, B to sort of C is, there's a lot of opportunities there. So really wanted to ask, what the panel thought of it, but it actually sort of came up before I had a chance. So, I'd like to delve into it a little bit more. Obviously, it is, I know a couple of people who, I know a powerlifter who has got a subscription-based website, and I think it's about £12.50 a month. But he's got about 18,000 subscribers to it. And what he's done is he's priced it at the point where, he's priced it at almost a Netflix price, where, to be fair, his active users are probably 50% of that, and he's priced it, and whether ethically yes or no, I'm not too sure, but he's priced it where there's people sort of almost forget about it, and he's got a very good reoccurring business model, albeit it's very reliant on him because of the way it's set up. But the subscription business model just seems like something that is going to continue to grow, and we'll be interested in everybody's thoughts on it, I suppose.
I think that marginal expenditure price point is critical. What's the amount of money that people basically fire and forget about? Until something happens and they happen to look through their bank account and think, why am I spending that £5 a month or £10 or whatever? So I think that's the first point. Going back to the comment that I think Siam made about Pret, there's a lot of debate when Pret launched their subscription. It's like, you're going to lose money on 5 coffees a day. But in truth, no one's going to buy 5 coffees a day in reality. So it's a brilliant promise. The percentage of people that they'll end up actually giving 5 coffees to, and clearly they would lose money on that, will be tiny.
Yeah.
The vast majority of people will have 1 or 2 coffees a day, which is fine. They'll probably make money on that. And there'll be a lot of people who won't have any coffee but still pay the subscription. So, that's the nature of subscription. It's like the gym model. So I think you're onto a winner, AJ, in terms of identifying that as a business model. If you've got something that you can do that, and obviously B2C is critical, less so perhaps B2B. But yeah, it's a great idea to explore for sure.
Can I just jump in and add some thoughts on this as well?
Yes, please, mate.
I'm massive fan of subscription models. It gives you predictability of cash flow. We were talking about that earlier. Secondly, it changes your cash flow cycle from negative to positive, so you're getting the money up front before you're paying out on your overheads.
Yep.
Thirdly, it has a material effect on your valuation. So instead of being the industry multiple times EBITDA, for many subscription businesses, it becomes the industry multiple times revenue, which is a phenomenal uptake. So if you're playing an arbitrage game, a multiple about making it more attractable for selling to a larger company or even floating it, so you're getting a rise in multiple for the industry and the arbitrage. But in addition, you're getting the rise in multiple by taking it as the industry multiple times revenue, and that's because investors don't like risk, and if you've got a consistent cash flow evidenced every month, and on the first of the month, whatever date it is, that amount of money is coming into your bank account. Investors like that because that they can take it to the bank. There's a lot less risk, so it's such an attractive business model.
Yeah, that's so true.
Guy, can I jump? Sorry, can I jump in on that one, Guy?
Please, Claire.
My the new business I'm about to launch is actually a subscription business. And no, Terry, it's not the coffee business. And what I wanted to say was, one of the things that's key, I think, for AJ, when you're looking at launching your subscription business, is your personal trainer chap is a great case in point. And people that go for a subscription are looking for some sort of transformation, and so your personal trainer guy, is turning them from Rabsi Nesbitt into Claude Van Damme. So that's what they're seeing. That's the transformation they're seeing. So it's great if you can find a sort of pain point for them and some transformation. What I'm launching is it's targeted at North Americans, and it is like a dip into Scottishness when you can't get here. So we're taking them around Scotland. We're introducing them to some great Scottish people, great Scottish products, that type of thing. So the transformation for them is that they can be connected to Scotland in a much deeper way than they can if they're coming here on holiday, because we're going to be speaking to the people in the businesses, and they'll be coming along with me on my journey around Scotland. So it's a sort of transformation thing is the sort of main thing if you're looking for a subscription business or product based.
Yeah, that's great, Claire. Thank you for that.
So 4 of my businesses are subscription based businesses, and I've got some pretty good words of warning based on hindsight, and they've been subscription based businesses for the last sort of 8 years. So the first thing is you absolutely really should not aim to have a subscription business. You need a payment plan business. So going back to the whole cash flow forecasting, if you have a subscription based business, it's really tricky to begin with to see what your lifetime value is of a customer, because they can leave after the first month, after the third month, or whatever. So you then have to wait 2 years just to see what your average lifetime value is of a new subscriber. So the way you combat that is you turn your business into a payment plan business. Okay, it's a slight tweak, but it will do wonders for your cash flow. So what they're actually doing is they're paying, instead of saying paying £30 a month for a year, you could say, right, pay £300 up front, or no, you could do like £30 times 12, but they're in a 12-month contract. So that way you know for a fact that they're going to be with you for at least a year. Now the other thing with the payment plan, I've seen some businesses try and do a payment plan over 18 months, 24 months. You must not go over 18 months, because then all of a sudden you're into FCA territory. So as a normal business, you can do payment plans up to, I think it's up to 18 months, but anything beyond that, you're about to expose yourself to a whole world of pain. Also, your CPA is like extortionately high. So your cost per acquisition is something which people massively overlook. So for example, one of my main businesses is called the Whap, the Wealth Action Plan. Not after that song. We've been here for years, by the way, long before that song. So the Whap is either £30 a month times 12 or £300 up front. Now, I ask this question a lot. So the process, the customer journey we have is basically 1 month free trial, and then they can become a Whapper. And how much do you think it costs me to get a free Whap trialer? Have a guess.
My guess would be about £50.
You're switched on though, the guy. You ruined it. So yeah.
I would say £30.
Yeah, so most people say, oh no, like £5, £10 or whatever. No. So the Whap for me cost me between £50 to £100 to get one free trialer. Now the beauty of the Whap is that we have a 54% conversion rate. So we know that trialers, at least half of them, become customers. But that's a bit rare. With the other businesses we have, the conversion rate from free trialer or even a low paid trialer to customer or client is something like 10 to 20%. So your CPA is going to be huge, and a good place to start is that it's going to be 2 to 3 times your yearly value. So there's one. So there's another business which is a £15 per month thing, but it still costs £60 to get a new customer. So straight away you then have to hope that new customer stays with you at least for 4 or 5 months, just so you can break even. And so yeah, and also if you're going down the disposable income level, below £20, £10, etc., and you really shouldn't. Not that you would, but you shouldn't run a business where you're hoping people forget that they're on a direct debit with you, because that isn't a good business.
See, that's an absolute critical point there, Siam. To get people, we do a club that's a membership kind of platform, and my thesis is, we're self-liquidating at the front end, but everybody that comes in, we basically provide that much value that the real people that are serious will stay in. Yeah. Because the value is insane compared to the price. I mean, it's ridiculous. So we work on a basis that we're not binding you in for 3 months, 6 months, a year. We're binding you in, and you drop us whenever you want to, because we're just going to drop some serious value and add some massive content and help create cash flow, grow your wealth, kind of thing. So I come from that point of view. add so much more than you're charging, it becomes irrelevant. And our model is really, it's £500 a month. But it sounds a lot. It's insignificant compared to what we're doing and helping people with. But the thing is, when they become an investor with us, it goes down to £250. When they invest the second time, it goes down to £100. Yeah. So it then becomes the Netflix of investing kind of thing. £100. Who cares if you're making the kind of returns that the investors are doing, plus the ancillary benefits. On top of that, becoming an investor, we get access to something that would cost I don't know, between 15 and 25 a year, like 1,000 for free. So the ancillary benefits are pretty awesome. So I would always recommend add value before you get them.
Oh yeah,
a lot of value, and then when you get them, just pile it on, blow them away.
Yeah. And it's also the back end. So most of the time, I would say 9 times out of 10, a subscription-based business is not profitable on that front end product. So the 15 quid a month or 10 quid a month, whatever you're planning, your business will not run on that. You have to have a profitable back end. So I've seen this time and time again. Like, I've bought businesses where they have a product and it could be 10 quid a month product or whatever, and it's just not making any profit. Zero profit. Because one, they don't know their lifetime value, they don't know the amount of transactions per year, blah blah blah. And all you need to do is go, so you have your ready-made fishing pond here. You have thousands of people that have done your free trial, thousands of people that have done your product that has dropped off. So you have some sort of fishing pond to then launch a back-end product, and it needs to be a chunky product, 500 quid a month thing or a $2,000 one-off thing, because then you can get throughput on that straight away.
I guess the issue is about progression, isn't it, through the value chain?
Yeah.
I mean, Dan, you're kind of doing it almost in a reverse sense. So come in at a decent level, and with a loyalty component and transactional experience, that cost goes down, but you still got that recurring revenue. Or you look at the sort of thing that Siam's talking about, where you start off at a lower level, but it makes profit when you move someone from that base entry point into something. And that's that kind of transact relationship, really. So
the great thing is
you just got to have it planned out, I think.
Yeah, exactly. And the great thing is there's no one size fits all. It's up to you. What is your real goal here, and then focus on that, the end in mind, and then work back. We want to downsell people. We don't want anyone on £500. We want everybody on £100, because, like a Netflix subscription, nobody cares, because the value should be, 15 to 25k a year. So we're just offering insane value because we're after two lots of people, active investors and passive investors, and they all collaborate together to make money collectively.
Yeah, absolutely. AJ, was that useful? Because obviously you popped up with the question, so I think it was an interesting debate that we all had there. Was that helpful?
Yeah, it was really useful. To be fair, it's not. I've been looking into it in the sense of just trying to learn more about it, and there isn't. There's a lot out there, and what Sam mentioned there regarding the 18-month contracts is interesting, and there's a lot of stuff to think about. So thank you very much. And to be fair, it's just good. Conflicting opinions as well, because
different angles. I think, as Dan said. Yeah, I think your signal's a bit ropey, AJ, but I think the gist of that was not conflicting angles. I would say different perspectives, really, from Dan's perspective, Gavin's perspective, Siam's experience as well. These are all really useful things. So good debate there, definitely. I'm just conscious.
I think one thing as well, is Siam is coming from a point of experience. This is not an idea. These are factual things that are happening right now in Siam for years. And so am I. So they're both right. And what's right for me or Siam might not be right for you. You're only limited by your own creativity.
And Gavin, Gavin's experience as well. That's the beauty of this panel, and all the scars. We're all held together by scar tissue, aren't we?
Yep, and attacked by Murphy.
Yeah. Absolutely. I'm just conscious that we're at 17 past. We always wrap up the room around about 12:30. Is there anybody else in the audience that wants to ask a question? We started today by talking about cash flow. Not sure we got into specific numbers. For for the benefit of the audience, the first 2 deals I did in 6 months made me £90,000. That's in the real world. That was back in the early mid-2000s. Those kind of numbers, today would be in 6 figures quite comfortably. And we always make money when we buy companies, we make money when we leave companies, when we exit, and we also make money, obviously, while we hold them. So back in the real world, buying and holding companies, growing them, improving them, and exiting is very much about a cash flow thing, and we touched on that. But I don't know if anyone in the audience has got a specific question around, okay, so how much money can I make or keep from buying companies? Perhaps that might help.
So, Guy, I'll throw one into the audience, to be fair. What is the, I suppose, I don't want to say minimum figure that you'd look for when you were, in terms of cash flow, when you were purchasing a company, but what would be, I suppose, obviously we've talked about, I think Siam said 30% net profit. But what would be the sort of, I suppose, minimum monthly cash flow you'd be happy with in a percentage of revenue or in a percentage of profit to make it viable?
So it's a really broad question. So to try to give a sense of perspective, the start point. It's a great question. But the start point, I think, for me, and what I advise to people is go down to real brass tacks. So for me, it's about return on time. What I spend my time on has to be reflected in what I get back for it. Because we can all be busy fools. We can run around, talk to business owners, try and do deals, get money on the table and so on. But what are you going to get for your time? Because we can make money, we can lose money, but we can't get time back. Time is our most precious commodity that, ekes away every day. So ask yourself what's enough for the return on time. That would be my basic question for anybody thinking about acquisitions or indeed being in business, really. If you run a business today and you're working your nuts off, but maybe it feels like your wheels are spinning, are you in the right business? Are you even doing the right thing? Because what's the point? When we all go back to dust, we can't take it with us. So, what's enough? That would be my first fundamental question. So, in brass tacks, somebody might be very happy to get maybe, another $5,000 a month. If the time cost to generate an extra $5,000 a month from having acquired a business, and if it's no money down, even better, that might be sufficient for what you need. For others, that might be way too inadequate, and sometimes experience is the teacher of that. You do a first deal and it's quite small, and you think, well, this is all right, and you can build from there. So for others, they might say, I don't want anything less than £50,000 in deal fees and £120,000 a year as a minimum management fee into my topco, for example. So it's quite a wide spectrum, but I think the best advice I can give is what is enough for you, your circumstances, and what is a really, really good return on your time. That would be my start point. I don't know if the rest of the panel have got any thoughts on that.
Yeah, I think that's an absolutely incredible point. Return on time, opportunity cost. It's really fundamental to everything. What business do you want to try and build? Do you want a business that's a lot of moving parts? Or do you prefer something else? Like I love businesses in a box where you do it once and then you set and forget for the next kind of 10, 20 years. That's a different kind of business, but it's still a business. But for me, it's return on time and return of capital. So how do you get return of capital? Even if you're not putting money in, you're putting your time in, you're putting money in. And for me, preservation of capital, return of capital is king, and that all comes down to debt serviceability. What's the multiple of net free cash flow, post-tax cash flow, and what multiple is that on full debt servicing? And what needs to happen on the top line or the gross profit line to then erode that back to kind of 2 times? Because a bank will insist on, depending on what kind of deal it is, 1.5 to 3 times, usually 2. But for me, if you're not doing deals at 3 to 6 times debt service, then perhaps you should be looking elsewhere or at the next one or renegotiating to decrease that deferred element from the vendor or the actual price itself. So for me, return on time, but keeping that time. If you're investing your time, what return on that capital are you getting back? So what's the risk profile of the deal? If you're 6 times debt servicing, that's not a bad place to be. If you're 2 times, you're at the races.
Phil, you pivoted your entire business really to get into this. What are your thoughts for AJ's question, which I think is a good one?
Yeah, I think it depends on your personal strategy and what you're looking to achieve out of buying the business. If you're looking to buy one business and run it and grow it and develop it, then it means that your entire income is going to come from that business. So what you need to get out of it, cash-wise, is going to be different to where it's one of a group of 10 businesses that you own, because obviously it all adds up. So if you own 10 businesses, you're not going to be putting as much time into each one. You can afford it to generate less cash for you per month. So I think the starting point for me is always, what's your strategy? What is it you need to achieve cash-wise? And then the question is, does this business get me there, or does it take me down the road towards where I need to be? Because you don't want to lock yourself effectively in a job which is not earning you as much money as you need to earn. That's the key thing to avoid.
Yeah, I think that's a great point. I would just add a thought as you were talking. I'm very fortunate. I mean, I'm not going to pretend that every day is golden and rosy. There are stressful days, there are difficult days, but I'm really lucky in the sense that it gets me out of bed every morning. I love what I do, and it isn't a job. It doesn't feel like a job. It doesn't feel like I'm a wage slave, and I look forward to the weekends. In fact, I don't look forward to the weekends because it means I've got to stop what I do during the week. I've got to take time out. Sounds a bit weird, but yeah, I'm really, really lucky in that I really love what I do. It motivates me and excites me. So, is what you do fun? Because if it isn't, why are you wasting your time on it? Return on time is critical. But Gavin, what are your thoughts, mate?
I concur with the points that you just made before. What is it going to deliver to you for your business, and to your return on time invested, and does it also have a strategic play in what you're trying to achieve? So one particular acquisition might not in the front end, we're looking one at now actually, it's a media property. In the front end it's not going to yield a lot of cash for us, but the access to that captive market and that list strategically is a big play down the line. So yeah, it's how does it fit as part of the bigger picture of what you...
I think we lost him.
Yeah, I'm back. Sorry about that.
I've got to shoot off, mate. But thanks for today again.
Cheers, Sam. Good to see you.
Have a good one.
See you next week.
Bye.
Yep. Bye.
Hey, Facebook. Hope that helped. I've got to shoot off. So sorry, but see you later. In fact, I'll be back on at 1600 if anyone's around. Bye.